Hello guys, today we're going to be doing section 5.5 of IB Business Management. This is a very, very crucial, important section in the IB Business Management syllabus because it really comes in almost every paper too. It's really, really, really important. And personally, it's one of my favorite sections. So let us begin. So firstly, we're going to be talking about what this contribution is. So basically, contribution shows how much a product contributes to a fixed cost of a business. So here we have a key term in the IB Business Management syllabus, which is fixed cost. What is fixed cost? So fixed cost is a cost that does not change proportionally to output. Okay, it does not. So an example of fixed cost is rent. It does not change depending on how much you produce. Whether you produce 10 units or you produced 100 units, you're still going to pay your rent no matter what, right? And thus its overall profit after deducting the variable costs. Okay, and then we have variable cost, which is another key term. It's basically a cost that does changes depending or like based on output, right? Variable cost, we have raw material, for example. Okay. So basically what the raw material that actually produced the good or the product, right? So basically so contribution basically shows how much a product contributes to the fixed cost and therefore the profit because they actually remove variable cost from the equation. So now let's actually show you the equation of contribution because there's two ways of calculating contribution itself and you have total contribution. So basically, contribution per unit is basically the price per unit. So what the good is sold for, so the price of the good, and then the variable cost per unit, what it costs the business to make the unit. Let's say there is a chocolate company, price is equivalent to $3, right? But it costs the company $1 to produce, right? So the contribution per unit would be 3 minus 1 equivalent to $2 because it is costing them $1 to make, but they're selling it for $3. So what they end up doing is that they contribute the other $2 to the fixed costs, okay? And then you have total contribution, which is basically total sales revenue. Now, what is sales revenue? Sales revenue is basically price times quantity, meaning the only thing added is the quantity sold. That's why it's total. It's the amount sold because here it's per unit. Here it's the total units, right? So it's price times quantity. And then total variable cost is basically the variable cost times quantity. Okay, so really that's it. So the only thing added to total contribution itself is quantity. You just have to multiply price per unit times the quantity. Then you have to multiply the variable cost per unit times the quantity. That's the only thing added to the total contribution. It's not a new formula. You just have to be given the quantity. That's really it. And then you have profit. So a way to calculate profit is by subtracting total contribution by total fixed cost, because we do know that contribution itself includes a variable costs, right? Because it's total sales revenue minus total variable costs. So the only thing you have to subtract by is total fixed cost. And why is that? Because we do know that profit is basically total revenue minus total costs, right? So so total cost is basically fixed cost plus variable costs. But since variable cost is already included in total contribution, the only thing we have to subtract by is fixed costs, okay? So this is basically it. That's the only thing that's different about this classical formula, because instead of doing, so I'm just going to write it here to clarify it even more. So basically profit, if you think about it, it's total revenue minus fixed cost plus variable cost. Okay, so once it becomes total revenue minus fixed cost minus variable cost, right? But if we already subtract total revenue minus variable cost, so these two, we're going to have total contribution. So what we have left is fixed cost minus fixed cost. That's it, okay? It's total fixed cost if you want, but yeah, that's really it. I hope you got when I explain that again. So now we have a break-even quantity. So what is the break-even quantity is very important. This is very, very, very important, you guys. You have to really know this section by heart. So break-even quantity is a measure of output where total revenue is equal to total cost. So basically, TR is equal to TC in this case. Minimum number of items that must be sold so that all costs are covered by sales revenue, okay? So here, the profit will be equivalent to 0 since total revenue is equivalent to total costs, right? And again, keep in mind, total revenue is price times quantity, total cost is fixed cost plus variable cost. Now, and then at the break-even cost, there is no loss but no profit either because, again, it is 0. Profit is 0. So the break-even chart is a graphical method of output that measures a firm's costs and revenues against a given level of output. Okay. So basically, it shows in the x-axis it has the output, and then in the y-axis it has the cost and revenues. So then it's like a measure. Now we have the component of a break-even chart, right? So you have fixed costs. So basically, fixed costs, like I previously said, they are paid whatever the level of output is because they are not proportional to the level of output. They are always paid. And I give you the example, it's rent. Variable costs, they do change proportionately to the output. And then you have total cost and total revenue, but I'm going to be explaining it proportionally to the graph. So we're going to begin. So basically, fixed cost, as you can see, fixed costs belongs above the 0. Okay, right? It's above 0. It's literally a horizontal line because it does not change depending on the output or sales. So output, sales, it basically does not change depending on that. Therefore, it's a horizontal line, okay? Because it doesn't change proportionately to the amount of output or sale, whether it's 0, whether it's 100, let's say, it's always the same no matter what. Therefore, it's horizontal, okay? But you have variable cost. Variable costs, they can actually start at 0 because if you produce 0 output, then you have 0 variable cost because variable cost is per unit. So the more you produce, the more your variable cost increases because again, it's proportionate. So I'm just going to re-add that, proportionate. Okay, so if it's 0, it's going to be 0 as well. If it's 100, then the variable cost will increase. Okay, and then we have the total cost. So total cost is basically fixed cost plus variable cost, right? So total cost will always also start at the y-axis of the fixed costs just because it has fixed cost and fixed cost is never 0, right? Therefore, it's going to start at fixed cost because variable cost can be 0, but fixed cost can never be 0. Therefore, it starts at fixed costs. And then you have total revenue, which is price times quantity. Total revenue also can start at 0, and then it increases and increases and increases. Then, when total revenue ends up meeting total costs, which is basically this area, this point, this is called the break-even point. This is when there is 0 profit. Okay, so here, profit equals 0. And as well as in this area, the business will be making profit. So because they will be actually selling more than the break-even output in this area. But in this area, the business will be making losses because they're selling less than the break-even output, right? So that's really it. Okay. And basically, break-even is the intersection between sorry, this is very, very wrong. I don't know why this has not been changed. Basically, it's between total costs, TC, and total revenue. This is very, 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 very wrong. Okay, sorry, this is very wrong. Okay. So yeah, now we're going to be continuing. So we have margin of safety. This is also frequently asked about in the IB Business Management syllabus. So let us continue. So basically, margin of safety. Margin of safety is the amount of output that exceeds the break-even quantity. And basically, it has to do with its name. So safety, right? That means that the business is safe. They're making money, right? So basically, when it exceeds the break-even quantity, it means that the business is making profit, right? So therefore, here you have the current output, and here you have the break-even output. This is how you calculate it. So basically, if the business's break-even output is, let's say, we're gonna correspond it to this. Okay, let's say the break-even output is 40, right? And they end up producing approximately 80, let's say. So their margin of safety is 80 minus 40, it is 40. When the margin of safety is positive, then they are making a profit, right? Okay, because they are producing more than the break-even quantity. So basically, the greater the difference between the current output and break-even output, the greater the margin of safety. And so the more profit the firm makes. So basically, if they end up producing at 100, then their margin of safety will be 60. So they'll produce even more profit, right? A firm producing below the break-even point is making losses and has a negative margin of safety, right? So let's say they're producing at 30. So they're producing something around here. 30. So their margin of safety will be negative 10. So margin of safety is 40, sorry, 30 minus 40, which is negative 10. So they'll be making losses. And this is evident as the total revenue here is basically less than the total cost, which is here, right? So you can see the difference here. Okay, so this is basically the concept of margin of safety. Now, so basically, negative means losses, positive means profit. Okay, so that's really what you have to know regarding margin of safety. Now we have calculating break-even quantity. So how do you calculate that? So basically, break-even quantity, the first formula I can use to calculate it is fixed costs divided by contribution per unit, right? Because contribution per unit, it does include, it's basically price minus variable cost. And they're both per unit. So per unit. But fixed cost isn't in the equation. So that's why you end up just dividing contribution per unit by fixed cost. Therefore, you have the price, you have the variable cost, and you have the fixed cost all in one equation. That's how you find the break-even quantity. Okay, so this is basically a formula. You kind of have to memorize it to a certain extent. And then you have the second formula, which I basically use in all of my exams, is you have to basically, because we do know that at a break-even quantity, total revenue equals total cost. And please, I'm writing in acronyms now, but you have to write the full words. I think it's just better. And maybe some examiners don't require you to, but I just think depending on your examiner, it's just really much better. And you just ensure that you get all your points, right? So now we're going to actually show you. So basically, since total revenue equals total cost, that means profit is 0. Okay. So this is for break even, right? So what you end up doing is you just do total revenue equals total cost, and then you break them down. So how do you break them down? How do you do that? So basically, total revenue is price times quantity, and then total cost is basically fixed cost plus variable cost. So in order for you to find break-even quantity, all you do is that you just do quantity equals to fixed cost plus variable cost divided by price. Okay. And you can also like just put total fixed cost, total variable costs. Okay, they're technically quite the same thing in context. So basically, this is how you find the break-even quantity. If you wanted to find the break-even price, then so this is for, because I don't want to confuse you guys, this is for quantity, okay? And then you have total, so basically you have break-even price. So break-even price would just be price equals to fixed cost plus variable cost divided by quantity, right? So this is just it's quite the same concept, and this is for price, okay? So that's just the only difference. I basically use this formula. Then you have for profit, okay? So now you need to calculate profit. So I wrote profit or loss just because sometimes you can have a loss. It doesn't have to be positive. Profit isn't always positive, and when profit is negative, then you have loss. Okay, so basically profit, it's basically either the formula we already went over, which is total contribution minus total fixed cost. Total contribution is basically total revenue minus total variable costs, okay? And then total fixed cost is just a fixed costs. Okay, so basically you do have everything. It's just profit equals to total revenue minus total variable cost. So you have this by itself, and then you just end up subtracting all of that by total fixed costs. That's really it. That's the formula when you break it down. Okay, then you have profit, the other formula, which is the classic formula as total revenue minus total cost. We do that total revenue is price times quantity. We do that total cost is fixed cost plus variable cost. That's really it, guys. They're technically the same thing, but you just have to know the concept of contribution. You just have to know what contribution is. Okay, they're just trying to see if you understand the concept. So this is what the IB are testing for. They're seeing if you know the concept. They're seeing if you know the nuances, if you understand what's happening. Basically, it's if you understand what's happening. That's all they want to know. If you know your terms, if you understand what's happening. Then you have the target profit. So basically, target profit is the level of output that is needed in order to make a specified amount of profit. So let's say the chocolate business I already talked about. They said they want to make $30,000 in profit. So how much chocolate should they sell to make this profit? Okay, so what they end up doing is that they end up adding fixed cost plus target profit over contribution per unit. And we do know that it's basically price per unit minus variable cost per unit, okay? So this is how they do it. If you want another way, which is the way I personally follow, which is I basically find quite easier because this can be complicated if your numbers are pretty ugly and they're pretty dense. You just follow the classic formula, which is this formula. You end up doing profit, target profit out, or you can just do profit equals total revenue minus total cost, which is price times quantity minus fixed cost plus variable costs, right? So this is all you have to do. And they want the target profit output. So you actually end up just really doing total revenue equals total costs. And then you end up doing price times quantity equals fixed cost plus variable cost. And then you end up doing quantity equals fixed cost plus variable cost over price. And that's how you get it, because they need to see how much they want to produce, right? So that's really it. For the quantity. Okay, so that's really it. Or instead, what you can do is that you can end up plugging the profit here. So you just plug your profit here, you put the profit. So in this case, it's like 30,000, right? Okay, so then you'll end up doing that. Okay, so that's really it. I did it in all of my exams where I just plugged the profit. I ended up putting the price, which is, oh, sorry. Ended up putting the price, which is $3, let's say, for the chocolate bar. I ended up putting the fixed cost, the variable cost, and I just isolated the quantity, right? So it would be 30,000 equals 3Q minus fixed cost plus variable cost. And I'll just put these in the parentheses together. And then what I'd end up doing is that I just end up taking minus 3Q equals minus 30,000 minus whatever number the fixed plus variable cost is, let's say 18,000. So I do that. I hope you guys can see. And then after I end up doing that, I get minus 3Q equals, let's say minus 30,000 minus 18,000, you have minus 48,000, right? So you end up just dividing by minus 3, you get Q, and then you get whatever number you really get, and that's really it. So you just get your answer, and yeah, that's quite it. So you probably get 16. So you get 16,000, and that's really it. So you end up just isolating them. So I hope you understood this because it was quite complicated, but you have to really do that in order for you to really get this. And now it's quite some explanation, but I hope you understood it. So they have to sell 16,000 chocolate bars. So then we have break-even revenue. So basically break-even revenue is the fixed cost divided by contribution per unit. So this is the break-even, right? So this by itself, you guys, is break-even quantity. That's the formula for break-even quantity. And then you have the price per unit, so the price per quantity, and then this is how you have your break-even revenue, okay? So you use break-even quantity, but then you just multiply by price per unit, and then you have your break-even revenue, that's it. So you just have to know your formula. Then you have effect of changes in price or costs. So now we're going to be dissecting each of these graphs and like understanding them, etc. So now we're going to begin. So you have changes in price, so an increase in price. So basically, when sales revenue increases at all levels of output, there's going to be shift in the revenue line from TR1 to TR2. So total revenue will increase, right? So it will just like basically break even output will decrease. So basically the profit will become 0 at a smaller unit, right? And it's actually shown here. So it shifts from here to here. You can see that shift, right? Okay. The firm will break even at a lower level of output, like I previously mentioned. There will also be higher profits at every level of output. And you can see that the total revenue increases. And then also leading to an increase in the firm's level of safety. This has to do with the margin of safety. Since margin of safety, reminder, it's basically current output minus break-even output. And basically, once break-even output decreases, right, margin of safety will increase. Okay, so basically that's like the concept of that. So this is for the price increase. Now we have changes in fixed costs. So once fixed costs increase, right, so we directly see that this horizontal line shifts upwards. And what happens when this horizontal line shifts upwards? The total cost will start at a greater cost. So basically, we do the total cost is basically fixed cost plus a variable cost. Once fixed cost increases, so does total cost. It increases as well. So total cost will start on a greater cost. And what will, so a greater number on the y-axis. And then what will happen is that the break-even output, the break-even level of output will have to increase. Why? Because it literally goes from here. I'm gonna use different colors just so you guys can see like properly. It goes from here to here. So you can see that great shift, right? So what will happen is that once the break-even level of output increases, you can see that the margin of safety will decrease. Okay, so the margin of safety in this case, since break-even output will increase, the margin of safety in this case will decrease. Okay, so the opposite will happen, right? And what will also decrease is actually profit. Profit decreases at all levels of output. And as you can see, for example, they were making at this level of output, so basically at this level of output, they're making a zero profit. But now at this level of output, they are making zero. So you see that the level of output, the profit decreases and the margin of safety decreases, like I previously mentioned, right? Then you have changes in variable costs. Okay, so basically an increase in variable cost. So basically we do know that fixed total cost is basically fixed cost is variable cost. I said that like 1,000 times, but basically what will happen is that total costs will increase, okay, and that what will happen is that the break even level of output will increase. So basically, you will go from this to this level, okay. This shift, you can see it. So the same thing happens, reduces in the margin of safety, rise in break-even quantity, and shift in total cost line from TC1 to TC2, and increases the gradient of the total cost line, okay. So that's what will happen, because basically total cost, the gradient will change, and it's just going, so basically total cost will increase. So it's just going to take longer for total cost to intersect with total revenue and longer for the break-even output, basically. That's basically it. So yeah, so benefits of break-even analysis. So now we're going to begin analyzing this. So basically, break-even charts help visualize a firm's profit or loss at various levels of sales. And we actually saw this. We really saw this in all of the charts. By using a break-even chart, a manager can determine the break-even quantity. So when the profit is zero, so how much a firm needs to sell, right? And then we have the margin of safety. So basically what the level of output that makes a firm profitable, right? Then you have the break-even revenue or costs. Formula and calculations can be used to confirm break-even charts and check the results. So basically it's basically based on logic. It can be backed up by calculations, okay? And changes in price in charts and their impact on profit or loss and break even. And the margin of safety can be compared by using charts or calculation. So they look at the changes in the chart, in the price, and how it affects. So here the firm can use the calculations for strategies and their calculations and for their future plans. Break-even analysis can be used as a strategic decision-making tool to decide on key investment projects. So like I previously mentioned, on whether a business should relocate or merge with another one. So what the business should do. So aids with financial decisions. Okay. And then you have limitations of a break-even analysis. Break-even analysis assumes that all units produced and sold, and that is not the case. So basically, all units that are produced will be sold, but that's obviously not the case because the demand's not always there, with no stick built up and held, right? But in many cases, stock is held by the business in case of any changes in demand. So basically, if you studied your syllabus and watched my videos, you will know that that's basically just in case production. I can't explain that now because we don't have time, but basically, yeah. Or sometimes stock is held because it cannot be sold. Sometimes there's simply no demand. So these external factors aren't taken into consideration, right? And then break-even analysis may not be suitable in very dynamic business environments with sudden changes in price, cost, and technology. So basically, break-even calculations require stability. Okay. And then you have there are price reductions at times or discounts that will influence the slope, right? There are seasons where there are discounts um, of the revenue line. Some workers can be paid overtime, which will affect the variable cost line. Sorry, that's cost line, not coastline. Cost line, thus affecting the changes of the total cost line. The accuracy and quality of the cost and revenue data used to determine the effectiveness of break-even analysis. Unreliable or inaccurate data may influence the conclusions reached in the overall analysis. Okay. Then you have semi-variable costs are not usually represented on the simple break-even chart, such as commissions, like not everything is on it. It's not 100% accurate. It lacks accuracy, lacks detail. Okay. Fixed cost may change at different levels of activity. For example, a firm may need to double its capacity to increase its output, thus leading to sharp increased fixed costs, complicating break-even analysis, meaning that basically when a firm, let's say this chocolate firm reaches, let's say a certain amount of production, like they're producing 40,000 chocolate bars, they can't use the exact machinery. They need to buy new machinery, they need to buy new equipment. So that increases fixed costs. So it kind of changes the situation. So I added just this one from the IB Business Management, like a old mark scheme. That's the benefits you get of being my students, you guys. So basically the break-even model assumes that all units produced are sold, therefore the total revenue received, if not all the dollars. Okay, so basically this is like about certain case, but it says the same thing. So this company like sells dolls. So here, as you can see, you can just see that it's also content and context, like I previously mentioned. So this will have a negative impact on the break-even point. The break-even model assumes a linear relationship between output and total variable cost, whereas in reality, the cost per unit can go down due to economies of scale, very important. So yeah. This will have negative impact on break-even point. The break-even model assumes that the price stays constant at all levels of output. In reality, price can be reduced or increased with direct impact on the break-even quantity. So basically, that's it, you guys. Thank you so much for watching. But this is the limitations and the like the benefits, I guess. So we talked a lot about the benefits. They had them prepare for the future. It helps them with their financial decisions. It helps them with their planning, it helps them with their marketing, with setting goals for their marketing team. But at the same time, there's so many things to take into consideration, like machinery, economies of scale, demand, the market, the industry, right? So this is it. Thank you so much, guys, for watching. I hope you enjoyed this video. I really loved explaining. This is one of my favorite sections. If you have any questions, please comment down below. If you have any break-even charts you want me to solve, any past papers, comment down below. I'm happy to solve those. And if you want some private tutoring, you can always email me. My email is down below. So thank you so much for watching. Bye bye, guys.